This is Tom Asprey with the Market Wrap video for the week ending March 14th. I just posted a new article on Forbes. You can always find all my articles by Googling Forbes Tom Asprey. It's titled 2 Stock Market Scenarios for the Month Ahead. I've been studying the history of the stock market for 45 years or so, and before I switched from being a biochemist, I spent about 5 years studying the early history, and it's given me some interesting insights to the market that may surprise you. So that's what we're going to focus on in today's video, as well as, of course, an update on which sectors I like in the month ahead. We've been focusing recently on the AAII Investor Sentiment Survey. Came out again last week at 19.1 bullish. So that means that that's a quite low level, as I'll show you in some charts. 19.3, 19.4, 3 weeks in a row it's been under 20. That's something you don't see very often. One good example occurred in early 2016 that I wrote about at the time, where we formed a very significant market bottom that lasted basically until early 2018. But the AD line had formed a divergence in May of 2015, and it resulted in this sharp 1,000-point drop here in August. Had a rebound back up in December, and then another wave of selling. So the point I want to focus on is in early January. You can see this line A. The bullish percentage at that point dropped to its lowest level in 5 years. So it was lower than any time during the bear market. We had a nice rally that I was expecting. So that's sort of scenario one. We get a couple of week rebound and then a drop back towards the previous lows that hold. So at those lows, you can see back in 2016, the bullish sentiment was not as low, which created a divergence that was also evident in many of the AD indicators. And you can see the ratio, bull minus bear, people use minus 30 as an extreme. So that means that if you subtract the bearish from the bullish, it's 30% greater number of bears than bulls. You can see here we dropped below 31, not on the initial one. This is a daily chart of that period. So we had the initial drop here, the lowest level of bullish sentiment since 2004, I believe. Had a nice sharp rally up, right back up to the pivot. It failed. We came back down here into the S1 and held that. And you can see when we were making that new low, there were bullish divergences in both versions of the McClellan oscillator here, as well as in some of the AD lines. So I was quite bullish at that point, and pretty much very few were. This is what those McClellan oscillators look currently after Friday's sharp bounce. You can see that both have broken their downtrends with Friday's action, which is a good start to completing a bottom. Also, you can see that the McClellan oscillators were both stronger now than they were in December, even though the averages are back to those lows. Let's look at the current chart. You can see the Spider Trust 4-week decline, quite sharp, took the SPY below its Stark bands for the past 2 weeks. That doesn't happen very often. You can see it happened in August, right before the market turned around last year, and also we got close in April, May, that 3-week decline that pretty much turned a lot of people bearish, but you don't get many times where you see multiple weeks below it. The problem for the market currently is the fact that even though the SPY and the S&P made higher highs in early 2025, the AD line did not. Okay, so this line C, is a bearish divergence. So that is something we need to resolve. The key support for the AD lines, both the S&P as well as the NYSE, are the September and late 20 2024 or early 2025 lows is line D. Why is that important? Well, if we drop below that, then we have started a new downtrend. We would have a high, a low, a lower high, and below that we'd have a lower low, the definition of a downtrend. The sentiment numbers suggest that we're not likely to go a lot lower over the near term. You can see here at the bottom, the bull minus bear is at minus 40. So how low is that? At the bear market low on March 5th of 2009, that ratio was minus 54, minus 51.4, and if you go back further, it reached minus 54 during the 1990 recession. So this is a pretty extreme level, and obviously you can see with the recent price action, it's being demonstrated in the market. This chart shows you the heavy selling since really the February 19th low, it's been pretty ugly. And you can see that, the selling appeared to be lessening over the past week or so. So back here, for example, in the S&P, 65% of the stocks were lower. Then this last week, there were 54, and then 46, and then on Friday, 80% were higher. So this, I think, it kicks off a rally. Now, of course, the main question, scenario one, suggests that rally would fail at important retracement resistance, and then we would get a drop back, in my view, towards the recent lows. Sharply lower lows, I think, are less likely because of the sentiment readings and the Stark band. See this chart of the QQQs shows you that it's also reached its Stark band for the past couple of weeks. The AD line crossed below its moving average for the first time since January. And we had a little blip right in here. It's still above the key support. So that's the support I'm watching for the NASDAQ 100 AD line. And you can see back here that we don't get down to these Stark bands very often. And generally when the AD line is making higher highs and higher lows like it is currently, those declines are buying opportunities. The daily chart and their AD lines still look pretty negative. So here we have the spider. You can see initial resistance at the declining 20-period exponential moving average is at 578. We closed at 562.81. And much stronger resistance, in the 100-day moving average, 591.80. And the 50-day at 592.55. You can see we did break below the 200 here in orange, which is right around 570. So you look at this whole decline here and you can come up with some retracement resistance. You can see the 38% for the S&P 500 is at 57.49, 50% 58.26, and 61.8% at 59.02. So basically a close above this level would signal, based on Fibonacci, that a bottom was in place. You can see that on the negative side, the 20 period is declining very sharply here. So, that's going to take some time to start turning higher. The S&P 500 AD line just plunged last week, but you can see the S&P, reached a low right around here of 578 in early 25. That's when the AD line made its low. So SPY is lower, AD line is higher. So that is a bullish sign suggesting that the price decline was weighted in just a few stocks. And of course, we know that some of the MAGA were down 16% or more, and cap-weighted averages bear the brunt of that decline. You can see the stocks only, we dropped to new lows. Okay, this is for the NYSE, so it's not looking at the same basket of stocks, but it's still negative, so it's got to move above. All these got to move back above their moving averages. That'd probably take, either a couple of strong back-to-back days or strong up, liner pullback, and a couple of strong days. And then, we'll have to watch, the downtrends from the highs we made in November to the highs we made in February, and that'd be the key resistance levels. So there are some encouraging signs from the other technical studies, but not all of them. Okay, high-low analysis, the fact that we, on last week's decline, though the price action was pretty weak, there was not an equal surge in the number of new lows. We were almost 300 in early March. This time it was like around 180 or so. If you look at the weekly AD lines on the NYSE, you can see both the NYSE stocks only and the all have crossed below their moving averages, but the NYSE all or stocks only is getting close to this key support, not the NYSE all. So, if we drop below then it would suggest to me that we're going to see, another sharp wave of selling. I haven't historically not found an instance where that occurred with the level of bearish sentiment as high as it is right now. This is another way to look at the extreme sentiment. So here we have in red the AAII bullish percentage, 19.1. You can see even in 2016 it was lower then than it was at the bear market low in 2009. The ratio did get quite a bit more negative at -50 right here, and now it's at -40. So last seen during the 2022 bear market in growth stocks. The VIX may have broken its uptrend. We dropped back below the moving average. So, that suggests we've retreated, from the high close to about 28 here down to 21. So, a further rally would push these down and suggest that the rebound is over. A little too early to conclude that right now, but you can see we don't, this is a really strong spike. Back then, we got up to in the high 30s. So far, we haven't made it above 30. So, that's an indication that the options market really are not as bearish as I think the futures market, where the short side of the market is getting a little crowded, I would think. The growth value ratio was lower again last week. You can see we're just closed right on this uptrend line B. So, it's been these sharp swings have been, sluggish. I started looking more at the technicals of the various indices, and right now the technicals for growth like XLK, look pretty negative. SMH is starting to look better. So I think, it's not going to be a straight growth or value play maybe in 2025. You can see the daily analysis of the NASDAQ 100, even though it's below its moving average and negative, it's still showing a long-term uptrend that, we've broken the price uptrend right back in February. The price uptrend would be like here, and we were broken, early in the decline and spent the whole month below the monthly pivot in March. That's never a good sign. If instead the AD line were acting weaker than prices, that's what you typically see in a start of a bear market like we did in 2007, 2008. The high-low analysis of the NASDAQ composite is also improved a little bit. You can see we got up to 400 new lows last week. We got over 650 on the prior low. So we have lower highs in the number of stocks making new lows. Why is that positive? It's against, as the NASDAQ composite was dropping down, fewer stocks were joining the party on the downside because fewer stocks were making new lows. This weekly chart of the NASDAQ composite shows you how oversold it is. 3 weeks in a row well below the weekly Stark bands You don't see that historically. You're going back the last 15 years very often. So you can see that for it, the 20-week EMA now is at 18,962. So that's roughly 1,600 points above the lows, and I guess 1,200 points below where we closed. One last reading. This is a chart I don't show very often, but I discussed. This is the number of QQQ stocks above their 10-period moving average. So right here, they're at 90%. As the market made its high in February 19th, you can see there was only 70%. So that's a divergence. You also get them on the downside. So, right here we got to 10%, and bumping into the Stark bands all the way down. So when you see that, as well as some of the AD line turning positive, that means it's time for a pretty good rally. For the ETF report, only 36.6% of the ETFs are above their quarterly pivot. So, we typically use 50. That could flip back quickly. You can see on the growth stocks, only the XLV is still positive based on the weekly as well as above its pivot. VHS is also positive on a weekly, but is slightly below its pivot. So in the value group, energies coming to life. You can see XLE, XOP, and VDE of daily DTS. Only XLE, based on probably Chevron and Exxon Mobil, are positive on a weekly basis. And clearly, the short ETFs are the place to be based on this. 100%, weekly and daily. I would expect this to change in the week ahead. So we'll start to get some daily sell signals if my view of a rally is correct. In the Forbes article, I also include a table showing the broadly held ETFs and their yearly pivots. So this is the table. You can see any ones that are shaded in yellow have closed just below their yearly pivots, but not by much. You can see, the QQQ could gain 2 points in probably 3 minutes of trading. So the close next week, if my bullish view is right, a bunch of these are going to close back above their yearly pivots. Most likely the QQQ, the healthcare, which is like 12 cents, I guess, below it. Semiconductors, and but consumer discretionary, that's a lot of room, as is the Russell 2000 and the XLK. So those are unlikely to turn around. So remember, you can use these yearly pivots. They're good for the whole year. So they're a support level as well as resistance, and we'll be publishing further articles down the road. Looking at the RS analysis from the sector report, energy, obviously has turned positive here. You can see PSX, VLO, daily, but not yet 3 days. So if they're going to move higher, we should see daily, with 3 day, and then weekly buy signals. XOM and CVX have already given those. Some gradual uptrend in the materials. FCX, industrials turned lower last week, but basically, it's moved above this peak, so that's a positive trend here. Still lots of red here, so we'll be watching some of these like GE, and John Deere, and Lockheed Martin are all showing some pretty good green characteristics. Consumer discretionary still looks really sick. I don't see anything. These guys will probably buck the trend. Consumer staples still looks really, it was down last week, but still really a positive trend here. Philip Morris gave a new 4-hour buy on Friday. Healthcare at 41%. It dropped a little further than I like, but we have some lots of stocks you can start looking on your watch list. Abbott, MDT, Amgen, etc. So BMY, which we're still in the stocks report, flashed a daily sell, but the weekly and the 3 day are still positive. Financials, this should be a pivotal week. If we can, the financials are strong. then the RS is going to flip back to positive. Right now, there's not a lot of green, and there's quite a bit of red, so there's lots of room for improvement there. Technology, not much. NVIDIA and AMD daily with their bounce at the end of the week. Communications looks, at 41. Technically, it still looks okay, as does the curve here. Typically, you would see more signs of a top, but it is declining, so we'll keep an eye on that. In utilities and REITs, though XLRE got really dumped during the week and broke a bunch of support levels, underlying here looks pretty good. If you want to learn more about stock market sentiment on the Viper report, there's this technical secrets showing some other charts, get you really watching it, and some tips on buying the dip. And of course, you want to subscribe and get specifics, Viper ETF report or hot stocks. That's where you can go to sign up. Each is just $34.95 a month, so a bargain, I would say. Well, thank you very much for tuning in, and we should have another video update next week.